Stoden from my house to yours. Welcome to EMS and the Economist. I'm here with Shawn Dubravac. Shawn, pleasure to see you as always. Thanks for taking the time.
Great to be with you, Phil.
Let's dig in with a couple of the elephants in the room. I wanted to touch on tariffs, but before that, since we last spoke, we did see a negative growth in the first quarter. Very small negative growth, but negative growth nonetheless. 2 quarters of negative growth is the fulfillment of the definition of recession. How do you see things looking by the time we get out of the second quarter?
I think it's first worth pointing out what really drove that decline in the first quarter, and it really isn't an indication of the underlying strength of the economy. It was really driven
Mhm.
by lopsided imports as everybody was pulling things forward, trying to get ahead of tariffs. You saw very strong imports. GDP, the way we measure GDP in the US is it's essentially net exports. And so you end up having this negative figure in Q1, primarily driven by the strong imports. If you exclude that, if you exclude trade, then the underlying um, momentum in the economy was actually okay. There was the
Mm.
demand was generally strong for Q1, and so it will be interesting to see how Q2 sets up. Obviously, you're not going to continue to see the lopsidedness in imports, and so that will settle out. At the same time, the underlying strength in the economy is slowing and has slowed, and so there's a bit more headwind now in the not only the U.S. economy, but I think the global economy broadly.
Yeah, yeah. And what about with respect to interest rates? The Fed seems somewhat confused by the tariff news, and it kind of made their decision making very difficult. And I think we've seen that elsewhere as well, where people have just taken a hiatus and kept rates where they are. Do you see that changing?
Yeah, the Fed has really taken a very much a wait and see approach and talked about
Mm.
being much more data dependent, feeling like they have the time to kind of wait. I joke that that's just economic talk for we also don't know what's going on.
Yeah.
There's a lot of uncertainty about how the tariffs will impact inflation, how it'll impact consumer demand and business demand, and also kind of more broadly where the tariffs will settle. I mean, it's not clear where
Mm.
those will end up. So I do think that the Fed is much more slow to react than and slow to cut rates than probably many people anticipate. The market last year was anticipating 5 rate cuts this year. Even a month ago, the markets were anticipating 4 rate cuts. It looks like right now the markets have readjusted after the last Fed meeting and Fed press conference to anticipate about 2 rate cuts this year, and those rate cuts not happening till later in the year. So I anticipate that interest rates will remain higher for longer than many people anticipate and expect. And we've
Yeah.
even seen the 10-year Treasury moving higher as the markets try to digest the implications for the current one big beautiful tax bill that the
Mm.
Congress is working on right now, and they've been going through reconciliation on that bill. And so there's some indication that that will probably add to the federal debt over the long term. And so you started to see the markets adjust those expectations, raise the yield that they're going to demand on that 10-year note. And so you have seen interest rates start to inch up here. And I think that's going to put not only short-term pressure, but potentially long-term pressure on firms and on borrowing costs.
Yeah, it has an impact, and it certainly has an impact on capex and that kind of investment side of the equation. Obviously, the other elephant in the room is tariffs. Last time we spoke, I think we were a bit in tariff turmoil, and we were I think there are literally things happening the weekend that we were chatting, and from one day to the next. And I think by the time we published, I think I got it out in 24 hours and stuff had changed already again. But both on the reciprocal tariffs and now more recently on the tariffs on China, we've got this kind of 90-day hiatus where there is time for negotiation and there seems to be at least some predictability in that period. What do you think that means in terms of the economy, but and specifically the electronics economy? I kind of get a sense that some of the Asian capex companies were holding off shipping stuff in. Now they're putting stuff on boats, thinking, okay, well, this is maybe a good time to ship stuff in. Are we going to see a lot of that product moving not based on demand, but based on when can we get it into the US under the lowest possible tariff?
Yeah, possibly. I think that we're in a very key time period. If you look more broadly, retailers are often placing their Black Friday and holiday orders around May. Like May is kind of the deadline to
Mm,
get those orders in and get everything shipped in. And so there was a lot of uncertainty around where tariffs are going to be that was impacting what those orders should be, what should be brought in, where it
mm,
should be brought in. And so there was I, I I think the pause came at an opportune time for retailers, gave them a little bit of clarity so that they could make those decisions, make those purchases, and start to think about the consumer shopping season this holiday season. I do think manufacturers will be opportunistic about when they can try to bring it in. I think there's still a lot of uncertainty, and we see that in all of the survey work that we do at IPC, that there's still a lot of uncertainty about tariffs. You see it outside of our
mm,
industry as well. And so it's not clear that we have a lot of clarity about it. A 90-day
mm.
pause is good, but it isn't, a pause is not a plan. And so it's not
No.
clear that that people feel like they're working in clear environment. I'm also not certain that we'll ever get clarity. I think that the
Mm,
administration likes having the ability to use tariffs, to threaten tariffs, to use tariffs more broadly than just trade negotiations. And so I think that this administration will use tariffs throughout the entire remainder of of the administration. And I think
yeah.
even more pronounced probably in the back half of their administration, should they lose in the midterm and should they lose control over Congress, the Senate, or the House, or both. I do think that the tools that they will have will be diminished, and so they'll be reliant on some of these executive orders more, and that's where something
Mm,
like tariffs would play in. So I think we'll continue to have a lot
yeah.
of uncertainty for the next 3 years about where we are. I do think
Yeah.
that we're going to see at least some minimum amount. 10% tariffs are probably here to stay. Obviously, the negotiations in Geneva, we made quick progress over a weekend, and we did kind of bring down some of those headline pressures. But
Mm,
I think there's still a lot of uncertainty, and I think it's clear that the tariff rates moving forward will be higher. And I think companies now are trying to figure out how much of this can we absorb, how much can we push
yeah.
back up the supply chain, and then how much of the supply chain needs to change so that we can recalibrate around these tariffs. And you've already seen that if you look at things like smartphone imports into the U.S. The imports coming from India were about 12% last year. In February, they were 28%. So you saw a
Yeah.
very big shift in a very short period of time in trying to
Yeah.
reallocate where all of this is coming from.
Yeah. And I think when you've got production based in different locations around the world, and tariffs are very specific to a single location from varying locations, you can actually choose where you ship that in from. definitely not afraid of using tariffs for the entire period, I think, and they're also definitely not afraid of a bit of chaos during that period. I actually think they seem to thrive on chaos, and it seems to be a tool that they're using. Um, Interestingly, I've had quite a few conversations with people that are looking to add manufacturing muscle in the US, whether they're European EMS companies or Asian or global EMS companies that don't have or want to scale a footprint in the US. So you have to ask the question of, is it working? And if you do want to build out a strong manufacturing ecosystem in the US, what part of this works and what other tools should be being used? Are the incentives around restrictions of where devices are shipped and those kind of things going to play well? So I think we're in a curious time of just kind of not just figuring out what's going to happen next, but what works and what outcome does everybody really want? Because I figure we're not going to be building iPhones anytime soon in the US, but maybe certainly products in the defense industry are becoming much more regionalized in their supply chains.
Yeah, if you look, I mean, there's been a lot of investment in new manufacturing capacity, some of that because of
Mm,
CHIPS Acts and other things like that. And so you are seeing investment, you have been seeing investment in new manufacturing capacity coming online. And I think that will continue. And some of it will perhaps reallocate to other sectors of the economy. For example, you had been seeing a lot of investment into the EV ecosystem as
mm,
as growth rates have slowed there. They're still quite strong, but as they've have slowed, maybe you see some of that investment moved elsewhere to other sectors of the economy. And our most recent sentiment report, which publishes this week, we did ask like, where are you looking at for new capacity? Have you added new capacity?
mm.
Are you seeking new capacity? And 17% of firms said that they are looking in the U.S. Another 6% said they're looking in Mexico. So you did see, um, it's a strong indication that firms are looking in the US. You also saw companies looking in Europe, you saw companies looking in Southeast
Mm.
Asia. So there are lots of
Yeah,
places that people are looking. And then the majority of firms actually are not looking for new capacity, at least they haven't in the last 60 days. So I think both things are true. You're seeing some companies look at, okay, I need to expand my capacity and my capabilities in places like the US. So let's start that process now. And
yeah.
others are saying, well, maybe now
Is
not
this
a
the way to go
great
or not? Yeah.
time. Let's wait for a little bit of more clarity before we start making major commitments. I do think for companies that are looking to add capacity, the US in some ways you're always going to be safe. I mean, it is a little bit of a challenge going, okay, where do I build if I want to serve the US market? Because uh, places like Mexico that used to look like a very
Very safe option. Yeah.
yeah, safe option from a financial clarity standpoint became less certain and wasn't sure if you were going to see tariffs imposed on those goods. And so,
Mm.
you're always going to be able to avoid tariffs if you're producing right
If
inside
you're in
that.
the US.
Yeah. So,
Yeah.
so I do
Yeah.
think you see
I
some of that.
think Yeah, I do think that's the way people are thinking, and like you say, I think we're in for a whole term of chaos. So I think waiting and seeing for 90 days or 6 months isn't enough. You either got to wait the whole term out, and obviously you don't know what's coming after this term, or you've just got to make your decisions. I have spoken to quite a lot of people that have global footprints and have really focused their efforts on building a layer of agility on top of those global footprints, because if you can't move stuff around, that doesn't really, you don't get the value out of that global footprint. And agility as a competitive advantage is definitely something people are thinking about, and perhaps using AI as a way of helping them to do that and helping them to have a little bit more control and predictability about demand and such. The other big sector that obviously is having a lot of impact in the US, but also in Europe is the defense industry. We're seeing a massive growth in defense spending in Europe, and we're seeing the European Parliament move much faster than we've seen it move for quite a while in terms of regulation, in terms of getting people together. Um, that's positive for Europe. It seems to be bringing them all together and getting them moving in one direction. An encouraging sign.
Yeah, I think so, and I think that all indications are that the war in Ukraine is not going to resolve anytime soon, and
Mm,
at least the negotiations that have occurred thus far haven't made much progress, and so that front of the world looks like it's still going to be uncertain and in some ways unstable, and so from a European
mm,
perspective there is this, in many ways, new desire to produce and to produce the defense electronics that are needed, and to also
yeah,
expand the amount that is invested on that. And so Europe has the potential to benefit from two of those shifts. One is the shift that we're going to spend more on this, and the second is we want to source it within the region. And
locally.
so
Yeah.
there's obviously good things happening there. And then in the last week, you've seen incredible announcements around investments in data centers and AI infrastructure happening in the Gulf region. So they are coming
Mm,
out as very strong players and making very big investments. Um, I mean, these are substantial investments in absolute terms, but very substantial investments as a percent of the amount that some of these countries in that region are spending, and so you're going
mm,
to see big growth in the years to come. And I think that was also a wake up call for other countries who are saying, "Wait, we want to be part of this AI wave as well." And so, if the Gulf is making big investments, where else should we be making big investments? And
yeah.
it's not surprising that these investments are tied to regions where you've seen big investments in power generation as well. And so
Yeah.
an investment in AI infrastructure and in data centers
Yeah.
is really an investment in uh, power generation and
Yeah.
electric generation. So I think you're going to still
Yeah.
see more announcements this year and next year on that because I think it was a very big wake up call for the rest of the world.
Yeah, absolutely. I think it's been fascinating on this last tour to see the some of the deals that are coming out, and some of the orders that are being placed on companies like Nvidia that are actually huge. But as you say, once you've got the data centers, there's a whole infrastructure requirement around that, and the production of energy is a huge part of it, and it's a game changer in that particular sector. But again, it's a sector that's definitely driving opportunity for the electronic manufacturing supply chain throughout. So yeah, I think that all bodes well. What's coming up in terms of activity from IPC with respect to data? You said the sentiment reports comes out in this week?
This week, and also we're releasing book to bill for both North America EMS and North America
Hmm.
PCB, and both of those remain quite strong. In the EMS sector, it
Mm,
looks like it's been aided in some part by weak fulfillment, by weak shipments, and so that's
hmm.
lifted the book to bill there.
Yeah,
Bookings look pretty flat year to date compared to last year. So I think to your point, you're seeing some shuffling happen
yeah,
beneath that headline number. Still, strength in defense electronics and probably some weakness in some other sectors that have paused while they recalibrate and reconfigure. And then in the PCB sector, continued strong orders. We saw really strong orders in April, keeping book to bill elevated. And
mm,
even with strong shipments in April, you still saw very strong bookings that outpaced shipments. And so I
yeah,
think there's still an indication there that uh, people are looking for supply. They're looking at, where they
Mm.
can acquire supply. Um,
Yeah.
and so I think that's going to
Yeah.
continue for the next
Robust
few months as
demand.
well.
Yeah, and I think we'll see that continue throughout the year. I was actually thinking in one of your first answers, you used the word that the economy was okay, and I just think everybody's happy with 2025 if it's okay. If we come out of it okay with a little bit of growth this year, I think everybody will be happy and looking forward to a 2026 where they've got maybe a bit more predictability and they can invest and perhaps see some more aggressive growth, particularly those that are in the defense sector.
Yeah, and I think the spread on expectations has really widened. So,
Mm,
while the average or the median expectations have declined in the U.S., we've gone from, the consensus expectation was for a little over 2% growth for the economy. Now you're a little over 1% growth for the economy. So that's a pretty significant step down. But the spread has also widened, and so there's probably, if depending upon what models you look at, 30 to 50% probability that the U.S. finds itself in recession this year. And I think despite the consumer being weak and the consumer being a large component of the economy, it really will come down to what businesses do. Yeah, if
mm,
businesses decide that they are going to curtail investment and hold off and wait for better clarity, then I think the U.S. will inevitably find itself in recession. And if businesses continue to invest as they have, then I think
mm,
the economy could surprise to the upside. Certainly, the markets have repriced their expectations. You saw a pretty good sell-off in the market that has all been recouped for the most part. The market's
mm.
relatively flat for the year after
Yeah,
seeing a pretty
after a big dip.
yeah. So market expectations, I think, and all of this is happening at a time when the expectations for the economy haven't really recovered. There's still expectations that growth
Mm,
is slower this year. So I think the market expectations there feel a little bit rich to me, but
yeah,
they do point to a much more optimistic view of the U.S. economy, at least, and arguably of the global economy. And it suggests that businesses will continue to invest. At least those expectations are baked in. So.
yeah. And I think when you look at those two markets we spoke of, defense and AI, investment can't slow down in either of those. They're both imperatives that are gonna drive continuous growth. Nobody can afford to be left behind in the race for domination of AI. And yeah, the volatility we see around the world continues to drive the defense sector, which continues to be more and more dependent on electronics. So it is what it is, and yeah, there's definitely opportunities for the companies that are working in those sectors. Shawn, thanks so much for your insight again. Always a pleasure to chat to you. Let's catch up again in a month and see what's happening.